Hello and welcome to Gold and Silver Assets. It's Sunday, the 5th of July, 2020. So thanks to all my viewers for the comments and questions about silver. And it seems there's quite a lot to discuss. So I'm going to have to spread these topics over multiple shows. But don't worry, I've made a list. So today I thought I'd cover a topic that many have asked about, and that is, will deflation crush the silver price? And people are particularly worried about this because silver is seen to be predominantly used as an industrial metal. And so they're worried that the price will drop if we see deflation. Now, I really enjoyed putting this show together, and I was actually quite surprised by the answer. So I hope you like it too. Let's start by recapping on what we mean by deflation, which can mean different things to different people. So a common definition is a fall in the prices of goods and services, and this would be indicated by a negative consumer price index, or CPI. That can either occur due to increased efficiency, productivity, and technical advances, which is a good kind of deflation. Alternatively, it could be a bad kind of deflation where there's a decline in demand. Others refer to deflation as a decrease in the money supply or a decrease in available credit. Some may also be referring to asset deflation, such as deflation in the stock market. But remember that it's possible for the stock market to deflate while other goods. The other thing to remember is that deflation is different from disinflation. Disinflation just means a lower level or less inflation. So prices are still rising, but by smaller amounts. This chart shows the history of the Consumer Price Index over 233 years in USA. So between 1785 and around the early 1900s, the currency was convertible to gold and silver. And we can see that during this time, there were huge swings between inflation and deflation. And these swings were by large amounts. So it ranged from plus 38% to minus 22% over here. And 43% of the years were spent in deflation. While the currency was under a gold standard, so from the early 1900s to the mid to late 1960s, we can see that the swings were much less severe and they occurred less frequently, with only 19% of the years being spent in deflation. Interestingly, during the fiat era, there's not really been any deflation to speak of. And that makes me wonder, is deflation likely to occur in the fiat era? That's, I think, is another question for another show. Let's compare how silver fared compared to gold and commodities when there was significant deflation. So in this chart, we can see that in 1814 to 1830, both gold and silver did well, while commodities did pretty badly. The episode from 1864 to 1897 is the Civil War greenback story that I discussed in my previous video about gold and deflation. And again, the precious metals held up pretty well, while the commodities suffered. But remember that during both these times, the currency was convertible for gold and silver. In the Great Depression, of course, it was in the gold standard and the gold price was fixed and raised by the government. However, silver prices did drop a bit and commodities again did very badly in comparison. And remember, we do not have any examples of any deflation to speak of in the USA during the fiat era. So looking at where the demand for silver comes from might help us. Around 60% is industrial demand for use in things like solar panels, electronics, batteries, and photography. And 20% is used to make jewellery. Investment in coins and bars makes up 15% of demand. So I think it's fair to say that currently silver is predominantly used as an industrial metal. So let's go back to the Great Depression. So at that time, jewellery and silverware demand was bound to have dropped. I don't know about the level of industrial usage of silver at that time, but again, I'm pretty sure it would have dropped. In terms of monetary demand, from 1900 to 1929, the annual consumption of silver coins in the USA was 8 million ounces a year. And this dropped off steeply so that between 1927 and 1931, it was only 1.64 million ounces a year. And actually, the US Mint stopped producing silver coins for a while. So it sounds like that there was an across-the-board decrease in silver demand, and that was also matched by a drop in silver production. So what's been happening over the last 30 years in terms of silver demand? This chart goes from 1976 to 2013. We can see that silver usage in photography has declined since the late 1990s, so that's shown here in green. Jewellery and silverware, that's shown in this dark blue, had increased from the 80s up until the late 1990s, but since then it has remained flat, and so that's basically shown by the thickness of this level. So it's basically stayed around the same. Then when we look at electronics and batteries, that has clearly increased from the late 90s. So this red band is getting larger. And interestingly, if we look at the coins, we can see that it's a very thin area up until around the year 2000 when it starts to get larger, and it gets particularly larger from around 2006. If we look more closely at the investment demand, the demand for coins and bars from 2008 to 2015 was 4 times that of the preceding 7-year period. And we know that the demand hasn't dropped off recently. Indeed, in recent months, we know that bullion dealers have had record sales of silver and many had sold out. Silver demand also comes from exchange-traded products. And this chart shows that, as with coins, the demand increased sharply in 2008 and remained high. It actually charged up in the late 2000s. And even as the silver price dropped off, this exchange-traded product demand remained high. And although it's not shown on the chart, the figure for 2020 is actually off the chart. It comes up to 896 million ounces. And in the last 6 months alone, it saw an increase of 167 million ounces, which is the highest ever inflow. And if this is particularly important if you consider that the second largest inflow for a whole year was 149 million ounces during 2009. So this shows that investment demand for silver is increasing, and if it continues, it suggests that this is something that's different to what occurred in the Great Depression. Although recent events may mean a decrease in industrial and jewellery demand, there's also a drop in silver supply, with about a third of the world's silver production being shut down temporarily. And as well as that, there is an increase in investment demand. Let's move on and take a look at the link between the stock market deflation and the silver price. So this chart goes from 1929 to 1935, and all prices are indexed to 100 in 1929. The red bars represent gold, the grey bars represent the Dow Jones index, and the cream coloured bars represent silver. And we can see that silver initially dropped with the stock market, but the drop became less while the stock market continued to decline, and actually silver ended up outperforming the stock market significantly, and so silver rose while the stock market continued to decline or slowly recover. Another way of looking at the relationship between the stock market and commodities is to look at the price of the commodity divided by the stock index. So what I really want to know from this is, does the price of silver behave like the price of an industrial metal? So this is a chart of the S&P GSCI Industrial Metals Index, and that's been divided by the S&P 500, and the chart covers 40 years. If we look at this chart, a low value basically means that the commodity is cheap relative to the stock market. And obviously a high value means that the commodity is expensive. And it's very easy to see that the commodities behave in a very cyclical fashion. And actually, we are currently at or near the lows of the cycle. Okay, so that's how industrial metals generally behave in relation to the stock market. So how does this compare with how silver behaves relative to the stock market? Well, this is the chart, and you can see it's very different indeed. To me, this suggests that the silver price probably doesn't behave like an industrial metal, certainly as far as things like the stock market relationship goes. Let's have a look at this from another angle. So this chart goes from 1992 to present. And in grey, we have the silver price, and the red line is the Bloomberg Industrial Metals Index. And that consists of aluminium, copper, nickel, and zinc. And both are expressed as a percentage change from 1992 levels. And below the chart here, we've got a plot of the correlation coefficient. So with the correlation coefficient, a value of +1 means that both indices move in the same direction, whereas if it's -1, then they always move in the opposite direction. And if it's 0, it means there's no real relationship between the two variables. And we can see that for most of the last 2 decades, the correlation has actually been positive and actually close to 1 a lot of the time. But interestingly, if we go back to before the year 2000, the relationship was actually negative for half of the time. And more recently, we have seen episodes where the correlation has been negative. So this calls into question the idea that the silver price always behaves like an industrial metal. My idea is that silver price responds more to trading and investment, and is therefore behaves more like gold. To test this idea, we can have a look at the correlation between the gold and silver price. And we can see that apart from these 2 short periods here, the correlation has been positive for the majority of the time, and most often has been close to 1. So this tells me that in terms of the direction of movement, silver behaves more like gold than it does an industrial metal. Now, the other thing to know is that silver does have a high beta to gold. So that means that when gold moves in a certain direction, then silver does tend to move by a greater amount in the same direction. And finally, how does silver relate to the stock market? So here's the silver price shown in grey and the Dow Jones index shown in blue. And it's clear to see that there's no real relationship between the two. If we look at the correlations, they swing between positive and negative. And so back to our original question, will deflation crush the silver price? And I was quite surprised by the answer. The big reason, of course, that people think that is because silver is seen as an industrial metal. And from what I've shown here, certainly silver is mainly used as an industrial metal. But interestingly, the silver price does not behave like it's an industrial metal. It behaves more as an investment and trading kind of instrument. And therefore, it seems to be more closely related to the price of gold. And therefore, the paper contracts probably do have a significant influence on that. So it's not really deflation per se that may affect gold. And that brings us to the topic of manipulation, and that's a topic for a whole different show. So overall, the answer to this question is no. Next up, the market update. So let's start with the gold priced in US dollars on the daily scale. And really not very much has happened in the past week. We seem to have broken out from this sideways movement, but not very much really. Again, we've got a smaller area of sideways movements. And that's something that does happen in the markets, where you get times where not very much is happening. Things are quite choppy as they are now. And so it's very difficult to make any kind of trading decisions like this. And these are the kind of times when it's usually just best to step back and watch. What you really want to look for is those times when good setups are starting to occur. And then that moves us into those other times where the real action starts to happen. So at the moment, we're in one of those quiet kind of times. And as I mentioned in previous shows, we do have a little bit of headroom here up to about the 1810 US dollar level. But actually, if you look at it, there's quite a bit of asymmetry here. So the upside seems a little bit limited. And this is because of heavy expected resistance above. But there is a fair amount of downside here. So possible support areas are 1,680 US dollars or just below the $1,640 level. There is a chance that it could go as low as the low 1500s, but it's getting less and less likely as time goes by. So I would mainly be working within this area over here. And just stepping back, looking at gold in US dollars on the monthly scale, we've been talking about this cup and handle pattern. At the moment, we've got what appears to be a cup, and we're basically looking out to see if a handle does form. And a handle usually wouldn't go much further on this chart, again, below around the 1,500 US dollars. Anything below that would be too deep, really, and we'd be looking at other potential patterns. And the reason why we would find support at around that level is because of support that we had previously here. And we've also got potential support from this area around here. Now, one of our viewers actually asked about an even bigger cup and handle pattern on a much bigger scale. So he basically said that the right side of the cup, the right lip of the cup, occurred in 1980. So I thought we'll have a quick look at that. So this is gold in US dollars, and this goes back up until the early 1900s here. So this gives us a really big view of what gold is doing. Around 1980 is over here. So again, this doesn't really look very much like a cup here. It's just not rounded enough. And, if it is, where's the lip here? Possibly here. But there's not a huge handle, maybe a tiny little one there, but it's not really that convincing. So then I thought, well, look, maybe let's look at this on the log scale. So again, this is 1980, and this is around 2011, 2012 area. But again, it's not really looking like much of a cup. And again, if this was the lip over here, then we're already kind of well progressed into that pattern. So then I thought, well, what about if we looked at the inflation adjusted gold price? And this is very interesting because first of all, we can see that the current price is actually cheaper than it was back in 1980. There's not many things that you can say that for. The other thing is this, on the log scale, this does look a little bit more cup-like, and we could say that, the right lip is here, the left lip is here, so they're, pretty similar levels, and this is the handle that's formed, and we're coming out of that. If this is indeed a cup and handle on the log scale, then the target price is absolutely massive. But I just thought it was interesting to look at the same chart in different ways. Let's move on to silver in US dollars on the daily scale. And we were talking about how silver has been moving in this upsloping channel. So we are still in an uptrend. And we've got two areas of resistance above. So this line over here, which is just above the 19 US dollar level, that's the big resistance level. And if we overcome that, we've got some big moves going upwards after that. And this is a shorter term resistance level, which joins these two highs over here. And it does seem to be resisting. So we tried to poke through that a few days ago, but it didn't really work. And really, we're spending more time along the lower end of this upsloping channel than we are at the top of this. And price is basically squeezing between the two. This area here is a kind of no man's land. So all kinds of things can happen with silver here that can try and mess with you. I mentioned earlier, silver can get a bit wild and it does tend to mess with people. So that's the area that's a little bit hazy in terms of where things can go. Right now, it's still looking like it wants to go down. And if it does go down, I think we've got a couple of support areas. There is a little bit of support at 17, and there's a huge amount of support just above the 15 US dollar level. If this does go down, this could be potentially a double top. Again, that would give us the target of, the low to mid 15 US dollar kind of level. So really, we just want to see if this area is going to break over here. And let's do like what we did with the gold chart and look at silver in a similar way. So this is the silver price chart, and we've got this curved area here that we had with gold, and silver actually went much higher than the previous high. But if we look on the log scale, it's quite interesting. Again, this goes back to the early 1900s here. And on the log scale, it seems to be in this upwards trend. And I've just drawn this trend line to join some of the lows here. Now, remember that we are on the log scale. And because this is a closing chart, this doesn't really show that $11 price move that we saw recently. So I think $11 will probably be somewhere around here. And so again, if it were to come down to hit this target here, remember that's only $10 there. And so I would have thought that is a potential, floor there. So I wouldn't be expecting $8 or $5 silver. But again, that depends on whether this trend holds. But remember, this has been holding for decades and decades. But even more interesting is looking at silver when it's been inflation adjusted. And we thought gold was cheap compared to the 1980 level. Well, take a look at this. So right now we're down here. So that's actually similar to what it cost in the 60s. I think you'd be hard pushed to find many things that are that cheap. And so this shows that there is a huge amount of upside and not really a lot of downside here. And so that's the kind of asymmetric trade I like to see. Limited downside, huge amount of upside potentially. But remember, you've got to be patient with these things. So we don't know how long silver is going to languish around here for. Let's move on to the GDX. And price has been moving up, but we've had an interesting candle in the last day. So just to draw it for you here, this is a shooting star candle. And so what this shows is that potentially it depends on what candle we get in the next trading day. So what we're looking for is a red candle that closes below the close of this candle here. And that would suggest more downwards movements. Now, of course, if we get a green candle and it doesn't close below this, then price can go back up to the top here. So what we're looking for, as I said, if we do get another red candle, then the next area to look for is a break of this down sloping line, which is around the mid 35 level. And the reason for that is that we've got this bearish pattern that seems to be forming. But again, that would only confirm if we see a close below that line. If we do, then we're looking at another retest of the support level here at 32, which is a very, very important level. As I mentioned before, we do have quite a few unfilled gaps here. So we've got one here, we've got one here, and another one here, and there's a tiny, tiny one over here. And gaps don't always have to fill. There's no rule that says they do have to. And we've got an example from 7 years ago where it actually did take 7 years for that gap to fill. But when I see a cluster of lots and lots of gaps, that just to me brings up a red flag. I have been burnt in the past by ignoring them. So it's just something that I keep in the back of my mind. And if we are taking all of this into account, as well as the fact that we have got decreasing volume here, then possibly what could be going on is a double top. So unless we get a new high here and price just steams upwards, which is possible still, we've got to keep all possibilities in mind. But if this is a double top, then that would give us a target down to around here, around the 25, 26 kind of level. And I would expect this kind of area to be reasonable support if you look back on the monthly scale at this chart. The fact that price broke through this 7-year resistance line is very, very positive. So if price does go down, don't be disheartened. Remember, we've cracked that ceiling. So the next time it goes up through there, it's probably going to smash through much more easily. And this is the GDX Junior, looking at that on the weekly scale. And this differs from the GDX in that we haven't broken through the upside resistance level. So we've got this large channel that's formed here. And what we've seen in the last trading week is that we've had a second go at trying to break that ceiling, but again, it failed. So we've got quite a long wick there. And so again, if the GDX is anything to go by, then potentially we could be looking at a double top here, in which case we'd be looking for price to come back down to around here. But you can see that there's quite a lot of support around this area here. So that's it from me. All the best, and we'll see you next week. Don't forget to like and subscribe. Bye.